Good afternoon and welcome to another Help for Homeowners webinar session. I am Clemente Mejia and I supervise the Foreclosure Prevention Unit at the Department of Consumer and Business Affairs. This week we'll be discussing refinancing during a pandemic. Next slide. The Los Angeles County Department of Consumer Affairs has been serving the consumers and business of Los Angeles County since 1976. Our mission is to promote a fair and vibrant marketplace. We serve consumers, businesses, and communities through education, advocacy, and complaint resolution. The economic downturn due to the pandemic has disrupted Excuse me a second. All right, sorry about that. Has disrupted sectors of the numerous non-essential businesses ceased operations and unemployment rates surged to near recession levels. Extreme measures have been taken to prevent mass evictions and foreclosures. Provisions of the CARES Act allowed renters and homeowners to stay in their homes without making a rental or mortgage payment for several months. In September, the federal government extended those protections. All this uncertainty, an opportunity has surfaced that per month. Since the onset of the COVID-19 pandemic, the Federal Reserve has lowered interest rates to historic lows. Although lending initially subsided for a short period of time, banks continue to advertise not determining out those who can could potentially reduce or eliminate costs. Today, our panelists will provide an overview of several factors to consider when taking on a new loan. We have Ani Dafti. Ani Cello, foreclosure prevention counselors who assist distressed property owners seek foreclosure with their lender or servicer. Please through the chat box.
Hi, I'm Ani, and again, today, Cello and I will be discussing refinancing during a pandemic. Today on our agenda, we're going to go over what refinancing is, some factors you should consider when refinancing, types of a refinance, consequences of a refinance scams, and finally, at the end, we'll go over any questions or comments that you may have. Now I'd like to introduce Cello, who will be going over what is a refinance.
Good afternoon, everyone. Again, my name is Cello, and together with Ani, we'll talk about refinancing at this time of pandemic. Next slide, please. Okay, let's start with the definition of what refinancing is. So refinancing is the replacement of your existing debt or mortgage with another debt or mortgage under different terms that is more favorable for you. Refinancing a mortgage is the process of acquiring a new loan to pay off an existing lender. You can only do refinancing on loans that need to be paid off before their maturity date. Next slide. So why you might want to refinance during COVID-19? Refinancing could save you money by lowering your mortgage payments. It will provide you with extra cash if you want to cash out the equity of your home. It can also consolidate debts into just one payment, therefore saving more money. Refinancing can also change the type of the loan. So from adjustable to fixed rate loans. Refinancing may also be used to remove another person from the mortgage. So let's say if you don't want other people from the original loan to get involved with this new loan, then you may do so with refinancing. Lower monthly mortgage payments, as what was mentioned earlier. Lower interest rates now due to the COVID-19 pandemic. This is very important because the low rates we're currently seeing right now is due to the COVID-19 economy. The Federal Reserve slashed interest rates in an effort to shore up the market and encourage home buying. Therefore, the mortgage rates followed suit. As of last week, the refinance rate we were looking at has an average, nationwide at around 3.03%. Next slide, please. What are the factors you should consider when refinancing? So the first one would be the market trends. So you make sure that you are up to date with the mortgage rate trends that are being offered right now, so that when you shop around, you'll get the best offer based on the trend. You can look at, the news on TV or newspapers for whatever mortgage rates available out there as of to date. Also, I'm looking at reliable websites online, like at bankrate.com. We're looking at between 2.5 to 3% interest rate right now or today. You can also use a mortgage refinance calculator to calculate the payment for the interest rate and compare rates offered. I'm going to give you an example after this slide. Our moderator, or Kevin, if you can please, what do you call that? I'm sorry, can you go back to the previous slide? Can you please click the link for the mortgage refinance calculator? Thank you. If it's not working, we can go back to the to the presentation. That's okay.
Yeah, Cello, let's try and work through it without it, please.
That's okay. Sorry about that. But anyway, that refinance mortgage calculator is the one from the nerdwallet.com. So if you can just Google it and search for NerdWallet mortgage refinance calculator. It's really user friendly. All you have to do is to input your numbers there, like your current mortgage amount, the current interest rate, the term of your loan, and then after that you will input your refinance. So what would be your mortgage rate should be the same, your term should be the same, but using the new interest rate that is in the market right now. So you can see there how much savings you'll get in a monthly basis. Pretty sure your monthly payment will get lower. So we really don't, but I'll give you an example later on. Another factor that you should consider is the loan fees and any prepayment penalties for the new loan. Later on, I'll show you that there are closing costs involved in refinancing and prepayment penalties, such as locking in the interest rate offered to you for a period of time. You may also want to review your credit history and credit score, making sure that it is high enough to qualify for refinancing at a low interest rate. So right now, because of the pandemic, the annualcreditreport.com is giving everyone a free access to their credit report. I believe Experian is giving free access to your credit score. So you may want to take advantage of that. The next one would be to review your current loan conditions, get your loan docs and your mortgage statement, how much is left to refinance. And you also want to know what is the current equity or the market value of your home. Finally, the general rule is if the new loan results in at least 1% and preferably a 2% or more decrease in your interest rate, then refinancing may be worth considering. Next slide, please. Okay, so in this slide, I just want to show in a tabular form how refinancing can save you money using the mortgage calculator. So again, I don't know if you have access to your computer, just go to nerdwallet.com and look for the Refinance mortgage calculator. But anyway, I tabulated it here. And if you're looking, this is just an example. So let's say your current mortgage on the second column is $200,000. Your term for that loan is 30 years. The interest rate that was given to you was 8%, and your monthly payment was $1,468. If you want to look at how much savings you can get through refinancing, again, use the mortgage calculator with the same mortgage amount, the same term, but using the current interest rate. So this 2.969% was a couple of days ago. Your monthly payment has decreased from $1,468 to $840 with a monthly savings of $628. Now, another refinance that you want to consider is refinancing in a short period of time. So instead of 30 years, you may want to input 20 years. The interest rate is the same. The monthly payment, there's just an increase of around $300, and your monthly payment is almost half of if you want to refinance with a 30-year term, so $362. However, if you're considering, lower interest rate and shorter time result in reducing interest paid over loan's life, you're actually saving around $100,000 of payment that will go towards interest rate, which I think is a very good deal. Next slide, please. Okay, so refinancing for different property types. If you're a homeowner with other types of properties and you would like to refinance them, lenders will not offer you the same low interest rate available for a primary residence. So the lowest rate available out there is only for primary residence, and you need to prove that you're living there for at least 1 year. If you have a secondary residence, like let's say a vacation home, the lender will offer you a higher interest rate. You will need a higher credit score to qualify and more requirements, for them to give you a reasonable interest rate. If you have an investment property, like let's say an apartment complex or a shopping complex, then the lender will give you the highest interest rate compared to the other two properties due to higher risk the lender must take on. This is the most challenging to refinance, again, due to the risk, and the guidelines to approve for refinancing are stricter. Next slide, please. Okay, shopping for a refinance during a pandemic. At this time, rates are fluctuating quicker than usual. So as we've seen in the examples previously, the rate as of last week was 3.03%. The interest rate a couple of days ago went down to 2.929%. And today, we're looking at between 2.5 to 3% of interest rate. So it's really, really in a high time low. The refinance can be handled by two separate banks or by getting a new mortgage loan with the same lender. So it is advisable that you check with your existing mortgage lender first to see if they can offer you the best interest rate. So if not, then you do your shopping. Also, the mortgage calculator can give you comparison of interest rates online. And finally, don't be afraid, again, to shop around and compare each lender's current rates, availability, and satisfaction scores. If you know any licensed brokers or licensed realtors, they can give you advice on this. Look for banks, credit unions, research their offers, and try to compare them across the board. Next slide, please. Okay, so here's a graph of mortgage rates prediction during pre and post-COVID. We just look at how the interest rates went down substantially, during the pre-COVID and the post-COVID. Record low mortgage this time is around 3.29%, but I think we're looking at much lower than that right now. This data was I acquired it from Mortgage Reports, and the link is right there. If you want to know about this graph further, then you can go ahead and click on that link. Next slide. This is just a tabular form of what the graph that we were looking at a while ago. The prediction of this following agencies for the third and fourth quarter of 2020, which is really at par of what are we looking at right now. So with Wells Fargo, which is a national bank, it's around 2.93%. With NAR, National Association of Realtors, 3.10%. The GSE, or the government-sponsored enterprise like Fannie Mae and Freddie Mac, we're looking at 3.05 to 3.20%. NAHB, or National Association of Home Builders, 3.25%. And MBA, or Mortgage Bankers Association, 3.55%. The average is around 3.18%. But again, as I've said, we're looking at interest rates lower than this. Next slide. Okay, so what is the process of refinancing? After you've decided the lender that will offer you refinancing, so you'll need to apply for it. Some of the requirements would be your recent pay stubs, W-2s, and recent bank statements. There are also forms to fill out, and the lenders will check your credit score. So as you can see here, when you apply for a refinancing, your lender asks for the same information you gave them when you bought a home. The your income, your assets, debt and credit score to determine whether you can pay back the loan. That's why it's important to know the factors when to consider refinancing before you apply, before you shop for the lender, and then you'll go on to this process. So after you get approved, you may be given the option to lock in your interest rate so it doesn't change before the loan closes. So this decision on if and when to lock in a mortgage rate will depend on your circumstances. It also has a lot to do with your tolerance for risk. So let's say if you lock in now a 2.5% interest rate, there's always a possibility that the rates will drop lower than that. But if you wait too long, and rates could unexpectedly creep up higher than desirable. So that's why financial advisors, they recommend not trying to time the market, but instead, if you're in good financial position with, let's say, continued income, and you have work, you can lock in your low rates today, which are, as what we've said, at near all-time lows. But keep in mind that there is a fee to pay for locking a rate, usually around $500. Rate locks last anywhere from 15 to 60 days. So the longer you wanted to wait for it, I guess the higher they're charging you for it. You might also be given the option to float your rate, which means not locking it before proceeding with the loan. This may allow you to get a lower rate, but it also puts you at risk for getting a higher one. So if the main takeaway here is that if you're happy with the rates at the time you're applying, then generally it is a good idea to go ahead and lock it. So once you submit your application, your lender begins the underwriting process. So during the underwriting, just like buying a home, your mortgage lender verifies your financial information and makes sure that everything you've submitted is accurate. But I think the underwriting for refinancing is way much faster than buying a house. And of course, just like when you bought your house, you must get an appraisal before you refinance. Your lender orders this appraisal, and the appraiser visits your property and receives an estimate of your home's value. This appraisal fee is paid by you, the homeowner. If the home's value is equal to or higher than the loan amount you want to refinance, it means that the underwriting is complete and your lender will contact you with the details of your closing. So once the underwriting and home appraisal are complete, it's time to close your new loan. A few days before closing, your lender will send you a document, which is called a closing disclosure, and that's where you'll see all the final numbers for your loan. At closing, you'll go over the details of the loan and sign your loan documents. This is when you'll pay any closing costs that aren't rolled into your loan. And if your lender owes you money, that is, if you're doing a cash out refinance, you'll receive the funds after closing. Next slide. Okay, so the following are the factors that will affect the cost of refinance. So the quotes that you get from your multiple lenders, of course, you need to choose which one has the best offer, your home's value, and an expectation that you'll pay between 2 to 3% of the total value of the loan for your refinancing. For the fees, it includes discount points. So I'll explain what discount points are in the following slide. The application fee, the attorney's fee if your property is in foreclosure, the title search, appraisal fee, local and tax fees. In some cases, you can roll your closing costs into your loan. So that depends on your lender. Next slide. Okay, so what are discount or mortgage points? So these are the fees to pay to reduce your mortgage interest rate and monthly payment. So it's like you're buying down the rate. Now, this depends on the lender. Some lenders, I think if your original interest rate is a higher interest rate, let's say 8% or more, then one discount point is equal to 1% of your mortgage amount. Some lenders, if you have a lower interest rate on your original loan, then one discount point is 0.5% or 0.25%. This is really negotiable and depends on the lender and also on the mortgage rates as it fluctuates daily. So as you can see on the table, this is an example of, like buying down the rate or the discount point. The original interest rate was 5%. The homeowner wanted to cut the rate to 4.75%, costing him $2,000 for that. So the principal and interest rate payment will be lowered down, giving him a saving of $30.35 in a monthly basis and breaking it even after 66 months. If the homeowner wanted to cut the 5% to 4.5, so that's 2 points or 2 discount points, then the homeowner will pay $4,000 for that, lowering down the principal and interest payment at $1,013.37 with a savings of $60.27 in a month, every month, and a break even after 67 months. Next slide. Okay, so the break-even point. So you have to consider how many months it will take to recoup the cash you used to refinance your loan. So remember this table on our previous example for the mortgage calculator, right? So we're just estimating, we wanted to find out if refinancing will be good at this type of scenario. However, the expenses for you to get the refinancing is this, it's around 7,330. So because of the discount point, so let's say the homeowner wanted to cut down the interest rate into 4,000, and then there's application fee, attorney fee, title search, appraisal fee, the local fees, and so on and so forth. So to calculate the break-even point, you divide your expenses by the monthly savings that you'll be able to get when you refinance. So for the 30-year term with that interest rate, so let's say the points has already been deducted there, or the discount point. So for you to break even the 7,330, it will take you 12 months or 1 year to break even. But if you want the 20-year term, so that's 7,330 divided by 362, it will give you 20 months or 1 year and 8 months to break even. Okay, and now let me give the floor to Ani to discuss the types of refinance loans. Ani?
Hello. Hi. So today I will be going over different types of refinance loans, including the cash out loan refinance, the rate and term loans, consolidation, home equity line of credit or HELOCs, and reverse mortgages. Can we go to the next slide, please? Okay, a cash out refinance loan is borrowing money from the equity of the property and is common when there is a rise in that equity. This means when the value of your home rises, you have access to its value with a refinance instead of selling it. This option enhances the overall loan amount and allows the borrower to gain immediate access to cash while maintaining ownership of their property. During a pandemic, this can be helpful if the homeowner has equity in their property and needs monetary or financial assistance.
Ani, we've lost your audio. Can you test again, please?
I'm sorry, Ani? Ani, we cannot hear you. Ani, we cannot hear you. We cannot hear you. There's no sound.
Hello? Hello, can you hear me?
Yes. Yeah, can you repeat your presentation on rate and term refinance loan? Because you were muted a while ago. Sorry.
Okay, that's fine. I apologize. So the rate and term refinance loan, this is the most common type of refinancing. So this specifically is used to pay off your loan with your current lender and allow you to pay a lesser amount with a lower interest rate. This replaces your old loan with a new one, can obtain a lower mortgage rate, and will get rid of your mortgage insurance, which has its own additional fees. This will also switch your loan program, allowing you to pay off your existing loan and start payment with a new lender. Okay, next slide, please. A consolidation refinance loan involves taking out a new loan to pay off other loans. Doing so helps the borrower pay off one loan instead of paying off multiple loans. For example, if you have a first and a second mortgage on your home, each loan will have its own interest rates and monthly payments. Consolidating the loans allows you to pay off your first and second mortgage while focusing on only paying one loan with one interest rate. Next slide, please. Okay. The home equity line of credit, or HELOC, lets you borrow a fixed amount secured and divided it in the equity of your home. So you will receive the money in a lump sum. The home equity line of credits are less commonly thought of as a refinance. However, you can refinance your first mortgage with a HELOC. This HELOC will have a fixed interest rate, fixed term, and fixed monthly payments. When your home equity loan rates are comparable to your mortgage rates, or when they have decreased, you may want to consider refinancing using your existing equity. This can help homeowners during the time of a pandemic, especially because they will have access to the equity in one lump sum, and some lenders do not charge origination fees or cash at closing like other refinances, such as the cash out loan might. Next slide, please. A refinance mortgage loan is usually secured by a residential property, and much like a HELOC or a cash-out loan, it enables the borrower to access the value of the property. However, to qualify, the borrower must be 62 years of age or older, so this is only an option for senior citizens. They must use their home as the principal residence, meaning it cannot be done on a rental property. The borrower must live there. They must either own the home, meaning they have completely paid off their mortgage, or have a low mortgage balance remaining, and they must not be delinquent on any federal debts. This is considered a type of refinancing when the borrower does have a low mortgage balance and will use the money from the reverse mortgage to pay off that amount. Okay, and can we go to the next slide, please? So refinancing comes with consequences, including restarting your mortgage clock, therefore extending the terms of your mortgage. An example of this would be assuming that you have 30 years to pay off your mortgage and you refinance 15 years into it. Instead of paying off your refinance in the next 15 years, it will restart the clock and you will have 30 years to pay that off. Refinancing does require a good credit score to get a lower rate. However, running your credit will slightly lower your score each time you run it. This could also raise your monthly expenses and lead you to owe more money. For example, let's assume you have a closing cost of $20,000 and cannot afford to pay that upfront. It will add to your monthly payments and with interest, meaning your monthly payments will rise and you may owe more. Okay, and can we go to the next slide, please? So there is a risk factor to refinancing with bad credit, as you may receive less favorable terms, higher rates, higher fees, and might have to resort to refinancing with hard money lenders that charge higher interest rates. Next slide, please. Okay, when shopping for a refinance, you want to be very careful because you may be faced with some scams. Scammers may offer fake mortgage relief plans, such as mortgage foreclosure relief, offering modified loans with upfront fees, which in the state of California is illegal. You should not be paying upfront fees. Scammers may also offer a guaranteed rock bottom rate for a nominal fee, meaning the borrower is offered, let's say, a 1% interest rate, which is extremely low. For example, with an upfront fee of, let's say, $30,000. However, the homeowner is actually signing up for an adjustable rate without their knowledge. So that 1% is increasing over time, and it results to having a very high interest rate. Borrowers may also be offered home repairs, improvements, or products, which is uncommon during the time of a refinance. You may also come across debt management scams or face identity theft. Next slide, please. So to avoid scams and get assistance, know the common scams and do your research before refinancing. Be aware of upfront fees, good faith deposits, and good faith deposits are normal. However, other fees such as appraisals or running your credit might be a red flag because some of these fees are normally paid through closing costs and not required upfront. And again, you shouldn't be charged upfront fees in the state of California unless it's a good faith payment. You also want to be aware of suspicious emails. When refinancing, you are putting your information out there, and this could be public record. Scammers can use that public record to get in touch with you and give you certain offers that might not benefit you. And contact your lender first about refinancing. Lenders normally talk about relationships with their consumers, and they will try to work with you in getting a good rate. But if you do not want to work with the same lender, you have the option to research other lenders' information and just see what's on the market. Okay, next slide, please. So if you believe that you have been scammed, you can contact the Los Angeles County Consumer and Business Affairs. We do have a mailing address. Right now, we are not taking any walk-ins due to the pandemic, but you can reach us by phone where we have multilingual staff available. Next slide, please. Okay. So if you think that you have been a victim of fraud or identity theft, you can file a report with your local law enforcement agency. We do recommend that. For the Federal Trade Commission, you may file a complaint online at their website, and you can contact the local district attorney's office. As of today, that is the Honorable Mr. Garcon, and he can be reached by phone at 213-974-3501, or you may also send in a fax. Next slide, please. There are regulatory agencies as well. Brokers are with the California Department of Real Estate. There are finance lenders, banks, or credit unions, which you can get information on through the DFPI website, and federal agencies such as the Office of the Comptroller of the Currency, Federal Reserve, Federal Deposit Insurance Corporation, and National Credit Union Administration as well. So now we can also go over any questions or comments that you may have.
Thank you, ladies. I did keep a tab of questions that came in through the chat, so I'll start reading off the questions and feel free to answer them. First question here that we have is, are there alternatives to refinancing so you don't have to pay the cost? This individual has heard of re-amortizations or recasting, but they're not sure what they really mean.
Okay, let me answer the question. Okay, so there are, in refinancing, it's always associated with costs. Your recasting or reamortization, that is recalculating your mortgage payments based on a new amortization schedule. So this also is associated with paying. During recasting, the borrower pays a large sum toward their principal and their mortgage, and is then recalculated based on that new balance. So you still have to put a big amount of money to do this recalculation. So what are the alternatives to refinancing so you don't have to pay the costs? Try loan modification. So that one, with loan modification, you will need to contact your lender. But the main thing for loan modification, the main requirement would be hardship. So you have to make sure that you let the lender know that let's say you're having a hard time paying your monthly mortgage due to let's say pandemic, unemployment, and so on and so forth. It is free. There are no costs associated with it. What else? Application for loan modification. It's almost the same thing as refinancing. They require you to submit your financial information. So yeah, so I don't think, so there's loan modification, there's no cost associated with it. I cannot think of any other alternative. Ani, Clem, do you have other suggestion?
Actually, there was a follow-up question to that, and the follow-up question was, does loan modification negatively impact your credit?
It does.
Okay, and just to follow up with Cello's response, generally loan modifications are considered in situations where the borrower has a hardship. And generally what that means is that the homeowner or borrower fell behind on payments. So when you're dealing with modifications and whether or not it negatively impacts your credit, it's really going to determine on whether or not you missed payments. And we're talking about 30 days late at least. So servicers and lenders will begin reporting that late payment to the credit bureaus once it becomes 30 days late. However, if you have not missed the payment, but you do foresee an issue with making the next month's payment, or you recently experienced a hardship, then being proactive and reaching out to your lender or servicer may be a good idea, and start communicating with them about your ability to make that payment. So it could be either way. But again, if you have not missed a payment, but you foresee a hardship, then it's probably best to contact them right away. And hopefully you can start the process before you miss that payment. Okay, so we're going to go ahead and with the next question. What should be my minimum credit score to refinance to a lower rate?
We're looking at 700. That's the minimum credit score. So the lenders, they wanted 700 and above credit scores for you to avail the competitive rates out there. So if you're below that, around 699 below, then expect that they will offer you a higher interest rate.
Great. Next question. So the lender has postponed their payment due to COVID-19 until January 2021. Do they have to contact their lender directly to refinance?
So you may get in touch with your lender to see what they're offering regarding a refinance. It is best to get in touch with your lender and see if they do have any programs or options for you before looking into the market. They do also have a relationship manager you can contact there to get further information regarding your delayed payment and when you can start your refinance.
I have a follow-up answer to that. So if your payment was postponed because of COVID-19 until the end of January 2021, that means you are in forbearance. And keep in mind that forbearance is not actually forgiveness. So that means you still have to pay what you owe to your lender. After that, so let's say if you cannot pay all the monthly payments that you skip, I don't think they will offer you refinancing. They will offer you some type of a loan modification for you to be able to make payments on it. So you can only do refinancing if you did not have any default on your mortgage payments. So if you have the money to pay all the skip payments at the end of forbearance, then maybe you can apply for refinance. But if you cannot afford it, then apply for a loan modification.
Yes, they're going to be offering you retention options instead of a refinance at that time.
Mm-hmm.
Okay, great. Next question. Any help for refinancing for homeowners that are not currently working but have equity in their home?
Annie, you want to answer that?
Yes, so if you have equity in your home, then you do have the option to refinance, and you can do this through the cash out loan. It does allow you to access cash through the equity that your home has. There is also the home equity line of credit, which again will allow you to access cash through the equity, and a reverse mortgage if you are 62 years of age or older.
Just one slight clarification with that. In this particular question, the individual is not currently working. So qualifying for a refinance will depend on your income and your ability to repay. So we do apologize for that mix-up. However, Ani did cover or review a loan product that may be beneficial. So if in this particular situation, if you're a senior citizen, then you may be able to benefit from a reverse mortgage. So again, as long as you meet those factors, those criterias of being 62 years old, you must live in the primary residence. You cannot transfer or move out of the property, and then you have to maintain your taxes and the property itself. And thank you for going back to that. Then you may be able to qualify. Reverse mortgage doesn't require you to make monthly payments, but it does grow over time. So the balance grows over time because they'll add whatever interest that's due for that month to the balance. So there is particular formulas for reverse mortgages. You must have a certain amount of equity, but again, you have to be 62 years old, live in the residence, and must be current on other things, for instance, property taxes and stuff like that. So there may be an option if you're a senior citizen. Okay, next question. Okay, so someone is on a COVID forbearance. Before they refinance, do they have to be current on that loan? Okay, so the question is, when you were granted the forbearance, if you were behind on payments, then that's already impacting your credit, right? So your credit score may have been negatively impacted for those missed payments. And then if you were placed on the forbearance, right, then you're still gonna be responsible for those payments that were postponed. However, we can't say that you will not be able to refinance. So whether you're behind prior to being granted a forbearance or you were not behind and you were granted a forbearance, it really depends on the lender as whether or not they'll be able to do the refinance for you. Um, so that's a good question. We would suggest that you work with maybe a mortgage consultant or someone that could assist you with that, but it is possible to refinance without having to pay all those arrears. But again, remember, upon refinancing, you're going to have to pay whatever interest is owed and whatever principal is owed as well. So even though you don't have to pay it before the transaction is completed, it's probably going to be wrapped into the total payoff. Is there anything you wanted to add to that, Cello?
No, I mean, I
Okay.
just want to,
That sounds
because you skip a question about someone refinanced last year. How can I figure out if it's worth refinancing again this year? So if you refinanced last year, you have to check your loan documents. Would there be a prepayment penalty if you pay it off sooner? So that is one factor you need to look at. You can also talk to your lender to see if you can refinance again this year. You cannot just refinance, like every year, I believe. But I think the main thing here is that take a look at your loan documents, see what are the requirements, make sure there's no prepayment penalty on it.
Okay. Next question. Is there any financial impact when changing the title from a trust to an individual during a refinance? And they provide an example. Will there be an increase in property taxes? Okay. If you want, I could take this one. Okay. When transferring title out of a trust to an individual, it depends on who's receiving ownership interest. For instance, if the beneficiary of the trust ended up being the same person that you're transferring it to, then there will be no what we call reassessment in property taxes. So, for instance, to give you an example, if John Smith owned the property, then John Smith transferred the property to the John Smith Trust, and now he needs to take it out of the trust and transfer it back to his own name, which is John Smith, then correct, there will be no impact as far as reassessments. However, if you transfer it to a non-qualifying individual, meaning to, for instance, a sibling or just a friend or an acquaintance, then that would be subject to reassessment. And this is in tax purposes. If you transfer it to a child or your spouse, then that transfer is exempt from a reassessment. And you just want to make sure you file the proper documentation so the assessor's office is aware of that. But again, if you're just transferring it out of your trust and putting it back into your name, there will be no issues with reassessments. On top of that, any other financial impact, of course, you're going to have the cost associated with that. So it's going to cost money to record the document. It's going to cost money to do the refinance. So there is some slight financial impact. But when it comes to taxes, as long as it's going back into your name, you should be okay. Okay, next question is, this person did not qualify for a refinance because their income decreased. What options do they have? So earlier you heard Cello and Ani talk about loan modification. So we could just go ahead and cover it real quick about a loan modification for someone that doesn't, who in this case, who experienced a financial hardship. Go ahead, ladies.
Annie, you want to talk about loan mod?
Yes. So, if you do not qualify for a refinance in this situation, you have the option to modify your loan to make it more affordable. Again, you must contact your lender to do this process, but we can also start a case with our department, you can reach us at this number listed on the screen now, and we can assist you with reaching out to your lender to look for some retention options that may essentially lower your monthly payments. So you will not be refinancing and working with a new loan. You will keep your current loan, but the interest rate might, or the overall monthly payments might be lowered depending on your lender.
Okay. Okay, so next question is, are there any government refinancing help for homeowners that lost their jobs due to the pandemic? Again, so this is probably going to be the same response that you just heard about modifications. For the most part, income and employment will be one of the determining factors when it comes to refinance. So if you don't have enough income, most likely you will probably not qualify for a refinance. But if you have a situation where your income was reduced, then maybe it might be a situation where you could do a modification, or even ask for a forbearance until you're able to either find a new job that pays a little more, or if it was an issue where your hours were reduced and your hours then were reinstated, then it might be feasible to do a refinance then. Okay, so let's see, we have time for a few more questions. Okay, so as far as recommending banks, unfortunately, we cannot recommend or refer members of the public to a specific bank or financial institution. But in a situation where they're limited on the loan products they're offering, just keep in mind that there's also other types of lenders out there. So you don't have to specifically go to a bank, for instance, like Wells Fargo, Bank of America. You could also go to what we call California finance lenders. So you may have heard of companies like Cash Call or Owning, or also like Quicken Loans or Rocket Mortgage. So those are also other options that you may want to look into. Again, it's best to shop around, so you could always ask for quotes to see what they're offering or what kind of loan products they're offering, especially now during the pandemic. But again, it's a good idea to shop around. Also, there's state charter banks, so there's smaller banks in the state of California that may also do that. And you may also want to look into credit unions. Usually credit unions offer pretty comparable rates to the members of a credit union. So that may be also an option. Okay. Let me just see if there's any other questions here that we can answer. Okay. I think I saw a question earlier that I left for the end, since it's specifically about modifications. So this person asked if they could do a loan modification more than once. So Ani or Cello, can you answer that?
I'm sorry, Clem, what's the question?
If someone's able to do a modification more than once.
More than once? Well, it depends how many mortgage do you have on your property. So let's say you have your first mortgage and you cannot afford to pay for that. You'll apply for a loan modification for that one. However, if you have another mortgage with a different bank and you want to lower the monthly payment, then you can also apply a loan modification on your second mortgage. But if you're talking about, let's say on your first mortgage, you applied for loan modification. It depends on when did you apply for it? Did you apply it 5 years ago? Or did you apply it this year and you want to apply it again? No, the lender will not allow you to do that. You need to have some time to really make payments on it on time. And then I believe around 5 years, then that's the time for you to take a look into it again and if you have a valid hardship, then you can talk to your lender again about applying for another loan modification.
Okay, so that's all the time we have for today. Thank you, Ani and Cello, for the thorough presentation. If you or someone you know needs assistance or has questions about housing, foreclosure, or available resources during the pandemic, please contact the Department of Consumer and Business Affairs. Our services are free and confidential. Thank you and have a good evening.
Thank you, everyone.